Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is real estate expert and fellow Pennsylvanian, Keith Weinhold. And Keith is the founder and owner of Get Rich Education, where he teaches people how to build wealth through buy and hold real estate investing. He's also the host of the top financial podcast, the Get Rich Education Show. He's an international best-selling author of the book, Seven Money Myths That Are Killing Your Wealth Potential. He writes for Forbes and the Rich Dad Advisors blog, and he is a member of the Forbes Real Estate Council. Now, Keith has been an active income property investor since 2002. He owns apartments in Alaska and single-family income property across the continental U.S. And we're going to actually be chatting with him today about his Alaska properties because at this point in time, he's divesting of those assets. And so we're going to ask him why and find out where in the rest of the United States he's placing his capital. And so, guys, with that, I'd like to welcome back Keith Weinhold. Keith, how you doing today, my friend?
Hey, great. Thank you. It's great to be back with a fellow native Pennsylvania.
Yeah.
It's been a few years since I was here.
Yeah, no, absolutely excited to have you back here. And we're both, for those that are watching, you can see that we're both wearing blue. Kind of made a joke about it, like almost the same color blue. We're on the same team here, speaking real estate.
Should one of us
today.
change? Yeah.
Exactly. Well, Keith, again, it's been quite some time since we've had you on the show, and a lot's transpired here over the last couple of years. More recently, we made it through an election year, and even witnessed, or I guess you could say, we're still in a state of a national pandemic. And so, I guess first and foremost, I'd love to find out, what's been new with you over the last couple of years. I think it's probably been about 2.5 years since we had you on. So maybe bring us back up to speed as to, what's going on in your life and business and all things great.
Sure. Well, you touched on it. I am based in Anchorage, Alaska, not a usual place to be from for a lot of people. Lived most of my life in Pennsylvania. And, recently, Kevin, in my own personal portfolio, before we talk about the broader real estate market, I am selling my local apartment buildings in Anchorage because, as I often say, the market is more important than the property. You need to keep in mind the economic vibrancy of a market, and are the diverse job sectors, and is there population growth, and is there job growth that are going to support rent paying tenants that can create that cash flow? And the answer locally in Anchorage has been no. We've been in an economic downspin even before the health crisis began, and that has to do with one 3-letter word: oil. The local economy is too dependent on a barrel of oil. We're not very well diversified. The price of a barrel of oil began to be cut in half in about 2014. It really hasn't come back, and we have population loss in both the city and the state. I don't see it turning around anytime soon. So with the market being more important than the property, I put my apartment buildings up for sale. And fortunately, I did get good offers on them pretty promptly that I accepted. So that's what's going on in my personal portfolio. Luckily, I've had the wherewithal, knowing that the market is more important than the property, for almost 10 years now, to be buying more turnkey property across state lines.
If I recall, you bought those Alaska properties quite a number of years back, correct? Back when you were first getting started. So you've had them in your portfolio for many, many years. What type of direct impacts have you seen with that downward spiral of the local economy on your rental properties? Have you seen, rents decline, longer to turn a unit and find a new qualified tenant? What are some of those, impacts that you've seen personally?
Yeah, that's a good question. What is the exact problem? I'm hemorrhaging money every day that I hold on to these local properties. It's really become a cash flow problem, Kevin. So the occupancy has stayed great. As soon as I have a vacancy, pretty soon, within a few weeks, we do have a new tenant that comes in to these Class C apartment buildings. And it's more of a cash flow problem because the amount of rent income that I get, Kevin, like on these 2 particular buildings, I bought them on consecutive days, one right after the other, 8 years ago. And since that time, I'm actually getting less in rent, not inflation adjusted rent, just in the nominal actual rent paid.
Wow.
I used to get about $10.50 for these 2-bed, 1-bath units. And now I'm only getting about $1,000. So actually some atrophy. So if you'd adjust that for inflation, maybe I'm getting 15 to 20% less in income. And of course, my mortgage principal and interest stays the same, but all of my other expenses, like the utility expenses, they're generally indexed to inflation, and so are property taxes, and so are property insurance. So my income side has actually gone down a little bit while my expenses have increased. That's why I'm selling. It's a cash flow problem.
Very, very interesting. And over what span of time did you see the decrease in rents? Was that a couple of years or?
Really buying these in 2013, really the local economic recession started about 2015 or 2016. So really that's when I began to see the atrophy in the rent amount. And it really all goes back to zero-based thinking. I've got to get rational, not be emotional, and ask myself, would I buy these properties again? And if the answer is no, I would not buy these properties again, then why do I continue to hold them in my portfolio? So I plan to sell and do a 1031 exchange. Now I am getting a little bit of appreciation. For example, the one building that I bought 8 years ago for $850K, I'm selling that for $998K. So there is some appreciation there. If you look at that on an annual basis, it's really not that much. And then I do plan to 1031 out of state into better, more vibrant markets. Again, it all comes back to the market is more important than the property.
Well, let's talk about that. I know you're a little further along with the sale of these properties. I'm sure that you've put a good bit of planning into exactly what markets you're going to set your focus on as far as those 1031 proceeds are concerned. And so tell me which you don't like Alaska, you don't like Anchorage as far as investing. Which markets do you love and why?
I kind of like the southeastern United States and parts of the Midwest. In parts of the Midwest, say Ohio, I'm seeing where I get better cash flow, and I can still, in some markets in Ohio, find 1% rent to value ratios, meaning I could get close to $1,500 rent on a 150K property. And then as I look in the southeastern quadrant of the United States, which is where I've been doing more of my own buying lately, so really Florida through Tennessee and Alabama into Texas, it's that quadrant that I really like. The cash flows generally aren't as high as they are in a Midwestern place like Indiana or Ohio, but I have better appreciation potential, and maybe something like on a single family home, more like 0.8% as a rent to value ratio in the Southeast. But in short, I like to invest in the Midwest for cash flow, and in the southeastern quadrant of the United States for probably a little less cash flow, but better appreciation potential, since we do see more population growth there.
And are we, Keith, are we typically talking, single family turnkey? Are these B, C class properties?
I like B class single family homes. That's what I've been buying lately. I really recommend to a lot of people on Get Rich Education to, use your 10 loan spots for those 1 to 4 unit properties, those Fannie Freddie loans at the best rates and terms. That's what I like to do. Use up those 10. But of course, for these larger apartment buildings, I'm probably going to need to 1031 into even larger apartment buildings. So when it comes to disposing of an asset these days, Kevin, I mean, you're aware of this. It's pretty easy to sell because we're in a hot market. Yeah. The problem that I have is I still haven't identified the replacement buildings for the ones I'm relinquishing in this 1031 exchange. The problem is that supply is so scarce. So on the good hand, I'm getting a lot of offers for my properties that I'm selling because property is scarce, but replacing them is the problem that I might have.
Yeah, no, that is probably the most challenging thing with a 1031 exchange. And I've had a few successful 1031s and multiple failed 1031s for the reason that you just outlined there, that it's incredibly challenging to find a quality replacement property. And, I'm sure you probably feel the same way in that, I will never find myself in a bind to where I feel forced to buy an inferior property or a property that's in an inferior marketplace just to avoid the tax man, right? And so I feel that some folks that do 1031 exchanges ultimately make that decision just to kick the can down the road on those capital gains and find themselves in a property that they might not have otherwise purchased if it weren't for a pressured time frame. What do you think about that?
You bring up a good point. It's like, don't let the tax tail wag the dog, as Rich Dad tax advisor Tom Ruay often reminds us. So we don't want to let taxes drive this thing. We want to let returns drive this thing. taxes are just a portion of that whole thing, that greater thing, that entire thing that gets taxed, which are returns. So yeah, I don't want to put myself into a bad deal for some tax efficiencies. And you know, it brings up something interesting, Kevin. It's something that a lot of people don't realize. It's the fact that taxation is not adjusted for inflation. So for example, in the building that I discussed earlier that I have for sale, I bought it 8 years ago for $850K, selling it for $998. Well, on an inflation adjusted basis, you know, so that might be a 15% gain over 8 years, something like a 2% gain. But on an inflation adjusted basis, that's really not any gain to my prosperity at all. To go from 850 to 998 in 8 years, that's only about commensurate with inflation. But the IRS doesn't adjust taxation for inflation. They're going to say, and they're going to recognize that gain of 148K anyway, and say you have a tax obligation on that if you don't exchange it. Now, of course, us as real estate investors, we're very lucky to have this vehicle of a 1031 like-kind exchange where I can go ahead and not have any tax obligation if I meet the criteria, identify another property within the timelines, and close on it. But this is kind of one frustrating thing with the tax code, and it's actually a good reason for capital gains tax rates being about half of ordinary income tax rates. But yeah, taxes can't drive the final decision. It's, you know, what's going to work best for me, what's going to be a profitable property. That's the key question, more so than the taxes are.
So is there a plan B? That's the big question. That's the $1 million question. That made up $1 million, but it's the expensive question.
Yeah, the plan B is potentially pay tax, but that's really unpalatable to me because as real estate investors, you know, we've got to realize that it's not just capital gains tax that we would have to pay. It's the depreciation recapture that we've been writing off on our taxes that becomes due as well if we don't exchange into other properties. So that's plan B. It's to take the hit and pay the tax, but that's really unpalatable. I don't plan to do that.
What's your stance aside from the recapture? You know, the other side of that argument is, well, you know, capital gains will never be as low as they are today, right? They're inevitably going to continue to go up over time. And so unless the 1031, unless, you know, the kick in the can down the road is a true estate planning strategy that you intend to kick it forever, ultimately at some point in time, you're going to pay the piper and you're going to pay him a much greater deal than what you would have, you know, during that initial sale. What are your thoughts there?
I've got a few thoughts, and to make it clear for people, capital gains tax rates are between 15 and 20% for most people. And like I stated earlier, that's about half of what your ordinary income tax rate is. But Kevin, I think you bring up something interesting, and I don't know if I'm getting ahead of you or not, but the question that a real estate investor needs to ask them today with who's in power in the White House and what their wishes are is the 1031 exchange going to continue to be a viable instrument for real estate investors? Now, previous presidential administrations had expressed an interest in killing the 1031 exchange, which allows us to legally defer every bit of our capital gains tax. In fact, as a 19-year real estate investor, I've never paid a dime of capital gains tax in my life. The Biden administration has proposed capping it at 500K, saying if you do a 1031 exchange, only the first 500K would be exempt from capital gains tax. Now, real estate investors need to be conscious of this. If this would go through, what it would probably do is force a rush of sales if we see this coming on the timeline, because people want to get their last 1031 in before the cap is added to it. And then once the cap is added to it, if that were to happen and there'd be a 500K cap, you got to think about what that does to your real estate investment portfolio and decisions. It would be really easy to exceed that much capital gain on apartment buildings, but if you're playing in the 1 to 4 unit space and the cap's 500K, that probably doesn't affect you as much. And if we did see a cap coming on the 1031, since that would cause a rush of sales, that would probably be a real boon to the real estate agent industry as well, because so many people would want to transact.
Yeah.
1031 exchanges are typically pretty good for real estate agents because they're paid based on transactions, and 1031s create a lot of transactions. So that's the one thing that someone really needs to be aware of if they want to take advantage of this great, great boon that we've had in the IRS tax code for 100 years. Yes, the 1031 exchange has existed since 1921.
That's absolutely amazing. So I haven't recently followed the commentary on the the conversation around the 1031 and putting a cap on it. Has it gotten any legs at this point, Keith, or is it still just talk?
You know, talking to Tom Wheelwright, I bring his name up again.
Yeah.
He's been a guest on my show 21 times, the most recurrent guest in history.
Oh my
So I
gosh.
talked to him a lot. He thinks it's more likely that income tax hikes up to 39.6%, currently the top rate's 37%. He thinks income tax hikes are more likely to go through than a capital gains tax package. So the potential cap on the 1031 is all part of this capital gains tax package. This package would have capital gains tax rates step up to ordinary income tax rates. They would about double, and have that cap on the 1031 tax deferred exchange. So it's felt it is less likely that that entire capital gains tax package will go through than the hike to the ordinary income tax rates would. So probably less than 50% is the perception that I get from talking with experts that are close to what's going on in the White House and Congress.
Well, that would be a sad, sad day if that capital gains package. It would be a sad day. In that event, we'd still figure a way, right? I mean, ultimately, there was where there's a will, there's a way, and time would only tell. But hopefully, we don't have to figure out that additional way at this present time. I want to pivot and switch gears for a moment, Keith. And we're recording this on August 10th. And, the eviction moratorium just a few days ago, it was slated to end, was said that was not going to be extended again. Now it's just been extended through, I believe it's October 3rd. I think it's the new date. What does your crystal ball say is going to happen once this truly finally ends once and for all? Is there going to be a slew of evictions? Are landlords going to work with tenants? Ultimately, if there is a slew of evictions, it's going to create a massive amount of vacancies in apartment complexes and single family homes, what have you. But what do you think the end result is? Is it severe, or is it just a little bit of headwinds for a period of time and then we work our way through it?
I think it's a moderate negative for real estate investors. To talk more about really what Congress and the White House wants to do today, they don't want people to lose their homes. And that can be a real problem if you're a landlord, because, of course, a lot of times the buck has stopped with us. As we know, the tenant in an eviction moratorium, they don't need to pay us the rent, but oftentimes we have to pay the mortgage to our lien holders, being the landlords like we are. So yes, indeed. It has been extended until October 3rd with this eviction moratorium. That's a real problem. But from my perspective, Kevin, I operate a lot in the 1 to 4 unit space, where we typically have tenants of higher quality that don't want to lose their home, that don't want to have a blemish or an eviction on their credit report. And, a lot of these tenants that live in single family homes, they tend to have better credit profiles, and they really don't want to lose their home, and they want to continue to pay the rent, because in that single family home, it kind of feels more like their own. So this is a short-term problem, but yes, it's definitely been a problem for real estate investors. And as the virus continues to mutate, it could only increase the chances of further extensions. But yeah, it's certainly a problem for real estate investors. We need to get that tenant out of there. And it's really frustrating because we have so much demand for housing here at the same time.
Correct. No, I agree with you there. I'm going to switch gears again and speak to a part of the conversation we had before we started recording here. And we were talking about, during 2020, really I guess the heart of the pandemic, but now we're entering back into another concentrated phase of it. But in any event, life was very different. And we started talking about, really your focus, and how your family was doing, how my family was doing, and kind of how we coped with things. And you made a mention that you really put an emphasis on your health, and really whipped yourself. You're always in really good shape, but you whipped yourself into really premium shape during that period of time, and really put a focus and emphasis on your health and fitness. Maybe speak to that a little bit, and how that intertwines with your business and your overall success as a real estate investor.
Yeah, I guess it gets a little philosophical, maybe slightly
No,
touchy-feely, Kevin, but health is wealth. And us as real estate investors, we tend to be contrarian and we tend to be long-term thinkers. And we probably tend to want to live a long time because we know how to get good returns. And we're not going to outlive our money. Our money is probably going to outlive us. So in financial freedom, which is what we're all trying to get, we want to enjoy life when we're young enough to actually do so. And a big part of that is being healthy. So yeah, to me, health is wealth. It just all goes together with this sort of long-term thinking that one needs to have. So yeah, fitness is a real priority to me. Finances are important too. I mean, that's what I'm known for talking about, but it just seems like it's intrinsically important to me to, before I take care of my wallet, to take care of my own body. It's just obvious.
So speaking to that, what does the daily routine of Keith Weinhold look like? Give us some additional context there as to, what this health and wellness plan looks like on a daily or weekly basis for you. Not to dig deep into the intimate side of Keith, but you don't have to talk about while you're in the shower or anything like that. But as far as working out, health and fitness, I follow your Facebook post, and you've done some incredible, hikes and runs, and and you live in a higher elevation environment with steep peaks, and so you do some fairly, I guess, what probably the average folks will consider to be extreme fitness endeavors, but that's all, I'm assuming that's all part of not necessarily your daily routine, but like you're just, again, this wellness routine. And so maybe speak to that a little bit. I think a lot of folks, they don't really, it makes it a little easier for them when they, Keith, you're a regular person, I'm a regular person, when they can get a better understanding of what really makes up that regular person, right? And part of you, outside of, again, the finances, is this health and wellness side. And so I think just having a better understanding of who you are behind the scenes, I think, is incredibly helpful.
Well, I kind of live in vacation land, a lot of people that have experience with Alaska come here on a glacier cruise. So to me, the outdoor environment, it's very motivating to want to stay fit and do some skiing and do some mountaineering. I commonly wake up at 6 a.m. I don't set any sort of alarm. It's kind of funny, Kevin. I might have to set an alarm, and I know this is going to annoy a lot of parents right now. Maybe 3 days a year, I need to set an alarm for some reason, an early flight or something like that. So I just naturally wake up pretty close to 6 in the morning, and I do my exercise in the morning. It's naturally when I have the highest energy level. And it also keeps your metabolism at a higher rate all day if you exercise in the morning. And that exercise can either be indoors in the gym or outdoors. I like to do both bodybuilding and HIIT workouts indoors, and then outdoors, it's cross-country skiing or running, or these steep mountaineering hikes where you might have seen me doing some of those on social media, where often you have a view of a glacier, and it's just a really inspiring place for me to want to stay fit. Anchorage is a city of almost 300,000 people, so I have plenty of amenities and choices here in this city. I'm a 10-minute drive from an international airport, a busy international airport. It's the second busiest cargo airport in the United States. However, once you get on that plane, it takes 3.5 hours just to get to Seattle, and then your trip starts. So Alaska does have more geographic isolation than a lot of people think, but it's really a special place to live if you want to be fit and if you want to be in the outdoors. And to tie that back into real estate investing, Kevin, I think most of us have heard the old mantra in real estate: live where you want to live and invest where the numbers make sense. But a lot of people don't do that. I'm truly doing that.
Yeah, no, I love every bit of that. And speaking to the alarm clock, up until about 3 years ago, I was, even if I didn't have to wake up for anything, I would set my alarm typically for 5 or 5:30. And I just, I'm not naturally, I'm not a person that wakes up at 5 or 5:30 in the morning. Even if I go to bed at 7 o'clock at night, I don't naturally wake up at that point in time, but I would always feel like I was missing out on something. So I always found myself in a weird routine for many years, again, up until just a few years ago, that I would ultimately, I didn't want to miss anything in the evening. So after the wife and the children would go to bed, I would, pull up my laptop and maybe catch up on some things, some emails, what have you, and go to sleep at 11 o'clock, but then ultimately force myself to get up early. And I just threw that out the window a couple of years ago. And I started allowing myself to wake up without an alarm clock. So just like you now, on average about 6 o'clock, 6:15, unless it's a early morning flight, which I do have a few of those a couple times throughout the year, but it has absolutely been a game changer. It's the most amazing thing to not have to set an alarm in the morning to wake up. I don't have that annoying sound. Even if you have the nice soft tone, it's still annoying as heck being woken up by this, digital noise machine. And so I love it. I absolutely love it. It's been a game changer for me. I feel
Good.
better, have more energy, and just life is much more beautiful without the alarm
Yeah.
clock.
Sure. I mean, a lot of people regard the United States as being one of the best nations to live in the world, and yet to have most of our population wake up to a nerd
Uh,
nerd nerd sound, and that's how your day starts. I mean, you got to change that. So I'm glad
yeah.
you did.
So pivoting back to real estate chat, before we work to wrap things up here, there's a couple questions I'd love to ask you. I started asking these a couple months ago on the show, and they've gotten a lot of positive feedback. And being that you've been in real estate for many years now, more than a decade as an active real estate investor, everyone tends to focus on the best deals they've done, the ones that have made the highest returns, made the most money, so on and so forth. Not many folks focus on the most challenging or the worst deal that they've done. And so what is that one deal that comes to mind? And maybe it wasn't a deal you lost money, but it was a deal that had, maybe it was hair, or maybe it was a bad partnership, but it had its fair share of challenges. Maybe you had some additional gray hairs come about of it. But what is that one deal? What was it? What were the challenges associated with it? And what would you have done differently, second time around?
Before 1031ing into these aforementioned apartment buildings, I probably should have looked into pivoting into a different market. It's these two apartment buildings that I currently have that are negatively cash flowing. And they've done that during a time where, at least leading up to this health crisis, things are booming in most other places. So luckily, I am investing across state lines, and I have for almost a decade now. But to continue to stay overweighted in a market that's not economically diverse really is the problem. Again, coming back to the market being more important than the property, in wanting to jettison these two apartment buildings.
Hmm.
And yeah, I mean, they don't even provide cash flow, and that's really the fundamental problem with them. I
Yeah.
use professional management, so at least I haven't been losing my time. It would be
Sure.
even worse if you're losing your money and you're losing your time on these. A lot of people think I must manage my property myself, even for the ones in my hometown. No, I don't, because a lot of people think about what's your ROI, and that's certainly important. But to me, it's what's your ROTI? What's your return on time invested?
Mm-hmm.
You want relative passivity with these things. But yeah, these local buildings, they've just been a real drain. Knowing I'm hemorrhaging cash every month into them, coming back to that fundamental question, you need to come with a top-down approach to real estate investing, and that's how you won't end up with mistakes in your portfolio. As I'm known for saying, Kevin, the property is only the fourth most important thing in real estate investing. I'm not saying it doesn't matter, but it's only the fourth most important thing. So we take a top-down approach. It's when you, the listener, the viewer here, when you ask yourself, why do you want to invest in real estate? You need to ask yourself, what's most important to you? Is it appreciation or tax benefits or lifestyle advantages with a property that you could use yourself? Or is it cash flow? What's more important to you? The second most important thing is that market. I've already talked about the importance of the market. The third most important thing is that team of professionals that you surround yourself with, because you might self-manage early, but over the long term, you're not in real estate investing to be getting texts from dozens of different tenants. So the third most important thing, your team, especially the property of your quality manager, those first three things, you, the market, and the team, are most important. And then when you've got those first three things figured out, Then and only then do you look at the property,
Hmm.
because those first three things really need to drive that decision, and then you won't end up with trouble in your portfolio. So maybe a little bit more bigger picture rather than be a nuance for an answer for you there, Kevin, but that conceptually is how a successful real estate investor thinks about the architecture
Yeah.
of their portfolio over time.
Yeah, no, that's great. I appreciate you sharing those insights. And I didn't realize that those were actually part of a 1031 initially, those two apartment complexes. So what do you think whoever the buyer, the buyer or buyers, I don't know if it's the same buyer for both those buildings, but
Different.
what is their investor profile? Is it just a place to, to preserve money? The cash buyers just don't know what else to do with it? Are they a 1031 exchange? I mean, do you know any of those intimate details?
That's a good question because, yeah, I asked my agent that question. Okay, who are these prospective buyers? Different buyers for each building. We did have one all cash offer, but it was kind of a low ball offer, so we dismissed that. But these are people that they're thinking that they're going to buy for cash flow. Of course, we're sharing the financials with them, and actually, Kevin, with the lenders for each of those uh, prospective buyers, we've had a few problems because the lenders are like, wait, the DCR, the debt coverage ratio,
Yeah.
doesn't look so good here. That being symptomatic of this cash flow problem that I've been talking about. So I really think these buyers are, like me, they're looking to put their money into something that might hold its value or might appreciate over time, but they're finding the problems with the
Hmm.
cash flow at the same time. But they're individual mom and pop investors that
Okay.
want to get a loan, much like I was when I bought the buildings.
So they might have to put more money down in order to meet that minimum DCR coverage, or something along those lines, or go with a different loan program altogether. But no, I always wonder that when you look at everyone's had a problem property, and all the problems are, sometimes different. I mean, maybe not the same problem as you with a negative cash flow, but ultimately a property is always going to either exceed your expectations or not meet your expectations, right? And so, speaking to the cash flow side, this one obviously did not meet your expectations. And so, I always wonder what that next buyer in line, are they a smarter investor? Are they going to operate it better? Do they know something that you don't know? Or are they inexperienced? Is that what it is? And so that's why I want to ask the question, just wondering what the buyer profile look like, and ultimately, do they have the magic pill that maybe Keith didn't have? And it doesn't sound like they do.
Yeah, my guess, Kevin, is that they're inexperienced. They don't have
Yeah,
this wherewithal to know that the market's more
right.
important than the property. And to buy in a place where jobs and population are contracting is really not the right thing to do. It's really not the place that you want to be. And, when it comes back to the DCR, yeah, you talked about, okay, one way to get around that is for that investor to make a larger down payment on the property, reducing their debt service, making it easier for that debt coverage ratio to be met for that lender so they can get a loan to buy this property from me. The other thing that we've done, Kevin, is me and my agent have asked my property manager to raise rents pretty aggressively on the existing tenants, not greater than the market value, but some were below rent. Well, let's raise that. That's another way to get on top of the debt coverage ratio problem so that people can buy these properties. But yeah, both of them together, Kevin, they cash flowed about $3,500 when I bought them 8 years ago, and now they provide negative cash flow. So that's how much I've hemorrhaged. That's how much
Wow.
a down market can harm an investor.
Yeah. One last question here, Keith, and then we'll wrap this thing up. As far as uh, bad deals, many times we get a deal, we get it locked up from the outside looking in. Before we actually peek underneath the hood, it looks great. We've seen financials on it. Maybe we haven't personally visited the property yet, but ultimately getting the due diligence. And if you've been in real estate investing for more than a couple of years, and more than likely if you're an active real estate investor like the two of us are, you've had deals that you've tied up that seem to look great from the outside looking in, that once you really dig underneath the hood, you start realizing and understanding things that you didn't anticipate, and ultimately it might lead to you walking away from the deal. The deal really doesn't add up to what you thought it would have from the front side looking into it. And so, maybe, is there any deal that comes to mind when I say that ultimately you got tied up, and that after digging in, doing your due diligence, taking a deep dive, you've decided to walk away for one reason or another? And if so, what were those reasons?
Yeah, one deal that I walked away from Kevin, a deal that didn't happen, it was another apartment building deal I was looking at buying a few years ago, is when you basically have a seller that's really, you can tell that they're not ethical because you can see a few signs in your due diligence process of considering buying that building. There was a building that I was considering buying, and we took a look at the rent income for the building. Oh, well, I learned that shortly before this seller put the property up for sale, they shortened the lease terms on all their new tenants to either 6-month leases or month-to-month leases rather than 12-month leases. So basically what they were able to do is jack up the rent amount on tenants that were only on month-to-month or 6-month leases. And a lot of times an investor is going to look at that and just run that as a potential income for themselves. But no, if you don't want that high turnover, and when you buy the building and you want to get year-to-year leases or multi-year leases, you can't get as high of an amount as you would on month-to-month or for these short-term leases. Another thing that this seller did that was revealed in the inspection was not disclose the fact that this property is actually fairly prone to flooding. In the inspection, when we looked on the drywall, we could see a mark on the drywall where floods had occurred. And another thing you really learn in your due diligence, and this is something else I learned and confirmed during that inspection with this person that appeared to be an unscrupulous seller, is the tenant was telling us about how often it floods in there. Oftentimes during your inspection, you don't have to be present, but if you can be, you get a lot of good information just by talking to the tenants of that existing building. Find out what's really going on. Find out, is the tenant upstairs, had their brother-in-law living with them for 8 months that aren't on the lease or whatever. So those are a few of the things that you can look for. Are people trying to jack up the rents with these really short-term leases? And during your inspection, actually talk to the tenants. They're the ones that have been living there for years. They know what's really going on with the operations, even better than a property manager would.
Yeah, no, absolutely agreed. Yeah, if you're buying a property, especially a multi-tenant property, and you're not actually having any of those conversations with tenants, and you're not actually putting your boots on the ground and being a part of those inspections, then you're doing yourself and your investors a huge disservice. I just, if it's a single family property, maybe you get away with it. But again, a multi-tenant property, I'm not sure exactly how that plays out in the long run. If you really don't have that additional insight that you just mentioned when you're local, boots on the ground, not local, but when you make yourself local there to do the inspections, boots on the ground. So with that, Keith, always a pleasure having you on the show. Always excited to bring you back on, and good to catch up with you again. It's been a couple of years. Wishing you and your wife all the best here through the remainder of this weird time that we find ourselves in. Wishing you guys wealth and happiness. And for those that want to learn more about you and all the different resources that you have available, Keith, where's the best place to find you?
The Get Rich Education podcast and the Get Rich Education YouTube channel. And I also have one resource I think your audience is going to like so much. They might find it the most valuable 1 hour of video watch that they've ever spent in real estate investing. And that is the free real estate investing course that I put together at getricheducation.com/course. And Kevin, you and I were talking about a lot of the downsides and things that could go wrong in real estate investing today, which is an important discussion to have because that's really where the lessons come in. Yeah. But even billionaire real estate investors often don't understand that they're paid 5 ways simultaneously. So I put together a course on the 5 ways that real estate investors are often simultaneously paid: appreciation, cash flow, your return on amortization, also known as your ROA, because your tenant is paying down your rent for you. 4th are the basket of tax benefits that you get. And then 5th is an inflation profiting benefit when you tie up long-term fixed interest rate debt that a lot of people don't understand. And Kevin, in this 5-video series, the videos average about 12 minutes each for a total of 60 minutes. I actually wear a different shirt color in each one of the videos. For the first one, appreciation, I wear the color blue because that conveys trust, meaning you trust in the appreciation process over the long term. In the second video, I wear a green shirt to signify cash flow and the green cash that you get, and so on. And when you understand your 5 simultaneous profit centers in real estate, not only do you understand why real estate is the one way to build generationally proven wealth where you don't even need a degree or certification to do it, But when you understand what all your 5 profit centers are, now you know what to buy, what to sell, when to sell. It opens up almost everything for you and actually come up with a total rate of return for you, an example of the 5 ways that you're paid in the 5 video series. So again, you could listen to the Get Rich Education podcast, our YouTube channel, or I really strongly recommend that course, the best 1 hour of real estate videos maybe you've ever seen, at least according to the humble creator here. And that is at getricheducation.com/course.
Awesome. Keith, again, thank you so much for coming on, and look forward to keeping in touch with you, bud.
Love chatting, Kevin. Thank you.
Alrighty, guys, that's all we have. So thank you for tuning into this week's show. And until we meet again next week, this is your host, Kevin Bubb, wishing you huge success. Take care.